What's good? It's Sam here, and I wanted to talk to you a little bit about something that I find super interesting and it excites me. That I don't feel like there's a good, simple explanation that I've seen out there. And it relates to options. Options are a financial derivative in the equity market and the bond market. Well, I mean, there's just tons of different ways to use options. Options, if you're the purchaser of an option, you have the right to purchase or sell something at a specified price. If you don't know what a fucking option is, Google it, and it'll probably do a much better job of explaining what it is. If you know what an option is, I wanted to talk about some of the inputs that go into pricing a option based on the Black-Scholes and Merton model. Those were researchers at different universities. Black is also a very well-known researcher. Merton and Scholes, if you know anything about finance and the research that goes into some of the traditional beliefs today, those three names make up a lot, or have touched a lot of different areas of finance. And there is anybody who's in the field has a true appreciation, or tends to have a very deep appreciation for those three individuals. I think Black may have passed away in around 2010 or 2012 or something like that. Anyways, so there's 5 inputs that go into it. There's the price of the underlying, which is the price of whatever the option is based on. If it's based on Apple stock, then the underlying is one of the factors that goes into the price of an option. There's the exercise price. So if you have a call option, you have if you're a purchaser, have the right to exercise at a specific price. If Apple's trading $100 a share and you purchased a call at 105, then the 105 is the exercise price. The next is the interest rate. A lot of textbooks will define that as the risk-free interest rate, and a lot of times the textbooks will define that as the treasury rate of interest on a 10-year, so it'd be like the U.S. Treasury 10-year interest rate. And you can find slight variations to how that's defined. If you can create a model that's more precise in the measurement of some of these inputs, then you can trade on that and make money off of it. So that's the third input. So we've got the price of the underlying, we've got the exercise price, and we've got the risk-free interest rate. Those are 3 of the inputs. The last 2 are the time to expiration, because there's going to be a specific time before this option expires. So it will be something along the lines of, if you were to purchase a call option at 105 on Apple stock that's trading at 100, the expiration might be, next week. It could be a few months down the road, or they have leap options as well, which are much longer in nature, where you might get those somewhere like 9 months or 12 months or longer. And lastly is the volatility of the underlying, and that's the price volatility of Apple stock as it goes up and down in the market. And all of those are directly observable except for the underlying. So, like, the underlying price you can get, the exercise price you can get, the risk-free interest rate you can get, the time to expiration you can get. The only thing you can't observe, you can observe it, but it's always in its post. It's after the fact, so you can't predict where it is going to be in the future. So that's where you get into volatility models in terms of gauging the predictability of volatility into the future. Hopefully I'm not losing all of you, but if this is super dry or super interesting, let me know down in the comments. I find this stuff super interesting. Anyways, So you take the three of those. Now, what I wanted to talk about was the delta. What is the fucking delta? A delta is a Greek letter, but what it represents is the change. It's a measure of risk. It measures the risk of the sensitivity of the price change, the ratio of the price change between the option price and the underlying price. Now let me explain that. I wrote down a few notes here, but the delta is if you have a ratio, right? So you've got the denominator and the numerator. The numerator of the delta of an option is the change in price of the option for a given change in price in the underlying. So if you were to think about that, if Apple stock goes from 100 to 101 and the price of the option on the call changes from $1 to $1.50, then you would take 50 cents, 50 divided by $1, and you would get a ratio of 0.5. And that is the delta of that call option with that specific expiration. So it's very, very conditional to that period. And excuse me, some of the interesting things with delta are you can do like a Monte Carlo simulation and see how the variables affect the delta. So there's also gamma, which is it's a second derivative. That's for another video. If you want to see a video about gamma and gamma explained, let me know down below in the comments, and I can put together something like that. Just let me know you'd like to see a video about the option gamma explained the way I explain it. Anyways, things that affect delta, you're going to have a different delta, a delta volatility with whether you're more in the money or out of the money with an option. In the money or out of the money is just going to be whether you're if the price of Apple stock is trading at 105 and the expiration price is 105, you're going to have a much greater volatility of delta because the price could go in the money, meaning you make money off the option, or could go out of the money, meaning you don't make money with the option because it's trading right at that precipice, right at that line where you can or can't. Now, if you're trading in the money and the exercise price is 105 still, but the actual price of Apple stock is 95, you have a much higher probability if you had sold that it's not going to come up and cross over your 105 mark. So the price of delta is going to change based on the actual price of the underlying, but it's also going to change based on the time horizon that you're looking at. Now, if you have something that's say 6 months out, if you have an option that expires in 6 months versus and I'm just coming off of memory, so if I fuck up one of these things, you can let me know down below in the comments. Be like, Sam, you fucked up. That is not accurate. Let me know down below in the comments. And I'll tell you to fuck off and I'll delete it. No, just kidding. Just kidding. But on the way down to the comments, you can press that subscribe button as well. So the time horizon, if you have one that's 6 months out versus one that's 1 month out or 1 week out, if you think about it from the possibilities, the number of possibilities increases with the greater time period. Meaning, if you have something that's going to expire next Thursday versus something that's going to expire in Thursday. So there's also specific rules around when options are expired, when they do expire. I believe it's like every Thursday if they're weekly options, or the third Thursday or Friday or something of every month if it's a monthly option, and then there's just different. You don't need to know any of those, but I do find that kind of stuff interesting. So if you have a weekly option that expires next week versus an option that expires in 6 months out, the possibility of changes in the underlying price between now and next week versus now and 6 months from now, the possibility of change is much greater for the one that's 6 months out than the one that is 1 week out. And given that, that also affects the delta and how it changes, or maybe the pace of change of delta. Just some interesting things. If you like this type of video, let me know by pressing that like button, and let me know down in the comments, and I'll make more videos like this in the future. If you want to come over and say hi on Instagram, it's sam.stolt, and I barely ever talk about finance over there, but come over and say hi. A lot more of it's about fitness, and I'm curious to know what your thoughts are. Peace. And if you subscribe and press that little bell notification, then you get to see this awesome face every single time I post a video. How could you not like that? I mean, look at this. Peace.